Thanks for joining us today on The Close. I'm Marella Fernandez. Market close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Retail sales were expected in November a little bit stronger. Data from StatsCan shows receipts rose 1.3% from the month before, driven by higher sales at food and beverage retailers. Sales were up in 7 provinces, led by Alberta, with higher sales at motor vehicles and parts dealers. In a flash estimate for December, StatsCan says retail sales likely fell 0.5%. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. But Ottawa is facing some criticism about that deal that the Prime Minister signed with the Chinese leader. The Ontario Premier Doug Ford recently urged Canadians to boycott all Chinese EVs. Ford says the vehicles puts thousands of auto sector jobs at risk. Bausch Health is one of the biggest decliners today on the TSX after the company's failure of 2 clinical trials. Both were testing a better form of drug known as rifaximin to see whether it could help prevent brain damage in adults with liver disease. The company CEO says they're reviewing the data now to identify new development opportunities. Shares of NVIDIA, Advanced Micro Devices, and Taiwan Semiconductor Manufacturing are trading higher. Bloomberg reporting China has told the country's largest tech firms they can prepare orders for NVIDIA's H200A1 chips. Now, it suggests Beijing is close to formally approving imports of components which are essential for powering artificial intelligence. All right, here's where we stand on the markets right now for the end of the trading week. 81 points up on the TSX. It remains above 33,000 right now. So not a lot of movement today, up about 0.25%. A mixed day south of the border. The S&P 500 not a material move. The Dow Jones, though, down 313 points, 0.6%. The NASDAQ is up today by 42 points. Silver has reached an all-time high of $100 an ounce. Spot gold closing in on the $5,000 $5,000. I'm like, let me get that straight, Jay. What does that tell you about the mindset of investors right now? Let's go to Jay Balla, CEO, Senior Portfolio Manager, AIP Asset Management. What does it tell you about what investors are thinking about if they're going to gold and silver? Sure.
I mean, I think it's just the broader picture of it all, right? I think, you had Mark Carney come on and talk about, sort of the end of the world order and the beginning of maybe a new era of, sort of competition between 2 great powers. And so, what you've seen is you've seen a lot of trade wars. You've seen a lot of deficit spending by governments all around the world. And I think, as you're seeing that gold price rally, it's really people feel more comfortable having a diversified pool of currencies now. Right? Because, if you think about how is the trade war being fought, how are these countries competing now, it's huge deficits. And the only way you can fund all these deficits now is you're effectively going to have to borrow tons and tons of money. So what does that really mean for your currency, right? And so, the thing we got to always think about is gold is the second reserve currency after the US dollar. And so with all this infighting going on, I think people are saying, look, let me just diversify my bets. I'm not as comfortable in the US dollar. I'm going to start buying gold. Okay. Right? And I think it's been a function of both things. I think this is, you've seen it with retail investors, but I think you're also seeing central banks around the world accumulating more gold, which I think is a bit of a paradigm shift, right? You've never really seen that movement, but I think, you're beginning to see that movement now. Okay, so it continues to be very telling. If a retail investor has had the run up in gold from last year and continues to have it now, how much do you suggest they hold? What weighting of your portfolio? Yeah, I mean, this always brings us back to our alternatives bucket. So, if you think of your alternatives bucket being kind of that 20% zone, gold might make up 5 of that 20. It might make up 10 of that 20, but you want to keep that range bound as well, right?
And what about silver? Should people hold both gold and silver, or do you sort of take one over the other?
I mean, I would take gold over silver. I mean, silver is, you can actually use silver for many, many things. It's got like an actual industrial use. It's not really a reserve per se. It just happens to kind of track on with gold, right? So, I mean, there's a bit of misnomer there. But I think gold, if you're worried about currencies, gold is your hedge. If you're thinking, the economy is going to continue to grow and you're bullish about economic growth, silver is probably a better play.
Okay, let's talk about investors needing to focus on policy. That's your advice for investors, but which policies do they need to focus on and why?
Sure. So I think there's been a lot of talk about sort of that strategic reshift, and I think a lot of countries have come out to say, look, we want to be that competitive edge, right? And so if you look at Canada, it's, what you really have to look in terms of policy movements is it's taxes more than anything else,
okay,
right? So if Canada wants to attract capital into the country, you got to be competitive, right? Ultimately, that's what it comes down to. And so, capital gains tax needs to go to zero. Taxes on interest income needs to come down very significantly. And so, as an example, the one I always give is, let's say you're talking to a foreign investor and they've got $10 million. Right? And you're saying, well, why don't you bring that 10 million to Canada? We've got great places for you to invest in. Okay, so now let's think about a bond or a GIC, which sounds great. So you buy a 5-year GIC for this person. He makes 3.5%. After taxes, he takes home less than 2%. And after inflation, he's going to lose money. So now how do we stand there in front of this guy who's already got $10 million to say, look, the only guarantee about the GIC is the fact that you'll lose money every year. Why don't you bring that money over here? It's very difficult, right? So it's nice to talk, but if you don't see the policy movement among governments to do that, it's very difficult to actually attract the capital. Right?
Okay. The Bank of Canada, of course, has signaled it is going to hold the rate. Do you think that's the right move?
I don't. I really don't. I think they need to be a bit more aggressive about cutting rates. And I think the reality is if you look at how much money they're spending, I think eventually they're going to start moving towards the idea of, rates need to come down if they want to keep sustaining this kind of deficits, right?
You are also keeping an eye on tech, I know, but you're looking at some of the IPOs as opposed to what we've all been paying attention to over the last couple of years. So
right.
What are you looking at?
In terms of the pre-IPO market, we've always talked about that. That's blossomed. It's become this gigantic market. It's a $4 trillion business now, and it's got all the fastest growing companies in the world and now all private. And so, the companies we own is we own SpaceX, we own OpenAI, and we own a basket of companies like this. And look, in the AI space, these are the fastest growing companies. This is where the true growth is coming. And the other part of all of this is, of course, it's a great opportunity for investors to make a lot of sort of decent returns in alpha, because a lot of these companies, I think, will go public in 2026. SpaceX has already come out to signal that they're going to go public sometime in that June, July timeframe. The rumors are that they've already started rounding up investment bankers. And, it'll be one of the largest IPOs, I guess, in history. So, look, I think there's going to be a lot of buying power as soon as it goes public. So that's going to be an additional boom for our investors, right?
Okay. Jay, got to leave it there. Thanks for coming in. Good to see you.
Perfect. Thank you so much.
Jay Bala, CEO, Senior Portfolio Manager, AIP Asset Management. Coming up next, Canadian retail sales rose by 1.3% in November, but an estimated decline for December. More in a moment. Canadians were very careful with their dollars at the end of last year. We have new retail numbers coming in from Statistics Canada today. Let's go through them with Vinayak Seshasai. He's Executive Vice President, Portfolio Manager at PIMCO. Vinayak, thanks for joining us today. What's your quick take first on the spending in November, and then what the last quarter of the year will look like?
Well, the spending in November was quite strong. But with these retail sales numbers, I think one thing we always like to caution people is that month to month, they tend to be very noisy. If you recall, November, the Jays were playing, and one of the big driver of upside surprise in retail sales was in food and beverages. So there could be a correlation there. We're also seeing a bit of give back in December. We really like to look at retail sales more on a trend basis, really see how it's been trending over the past year or so. And that tells us that it's really been much more flat to sideways. So on a real volume basis, we actually haven't seen any growth in retail sales over the past year or so. That is consistent with the signals we're getting about the economy from other sources like, GDP, the business surveys, et cetera, that it has generally been a tough year for the economy. The consumer has overall been feeling the pinch in their pockets. And I think that kind of lukewarm economic state continues.
Okay, so is it still then tariffs that are concerning people, or is it world conflict and the possibilities there, a combination of both?
For Canada, domestically, we think there's two main issues that are concerning people right now. One certainly is the uncertainty related to tariffs, which is going to continue to be a headwind to the economy this year. The second is housing. Housing, as you know, has been facing a rather tough path, particularly in Ontario and BC, which are the two biggest markets in the country. And house prices in Toronto, the GTA in particular, are now down almost 25%, depending on where you look. So I think those are the two main concerns. And I think those are probably the two biggest headwinds to growth over the next several months.
Okay, let's talk about CUSMA. I'm wondering how concerns about the trade deal not being renewed are hanging around. We had recent comments this week by Howard Lutnick talking about Canada's deal with China and how that could affect discussions. Do you think that is still something that's weighing on people?
I think it's something that genuinely should be a concern. It is up for review this year, and we actually see many possible paths that these negotiations can take. Not only Howard Lutnick, but also the U.S. Trade Representative Jamieson Greer has alluded to the possibility of not renewing CUSMA in its current state as a tri-party agreement, but maybe moving to bilateral agreements, one with the U.S. and China and one with the U.S. and Mexico. And the additional thing is that the trade relationship between the U.S. and Canada is probably the most complex, maybe with the exception of Mexico. So it was a lot easier for the U.S. administration to negotiate some of the other trade deals with countries on different continents. With Canada, just because the relationships are so deep and intricate, it's likely to be a long and protracted negotiation taking several months. There are likely to be a lot of headlines during those months that may drive not only markets, but also sentiment and businesses' desire to invest and create jobs. So we do think that it's likely to be a concern that's going to weigh upon people. Maybe to some extent, it's already factored into how businesses have been operating, in the sense that, the slowdown in the economy that we were going to see because of the trade uncertainty was already felt in 2025. And so maybe the shock in 2026 won't be that big. But there still is quite a lot of uncertainty around this. And so it is one of the major issues that is at stake this year.
I'm wondering if you think the Bank of Canada cuts that did happen, the rate cuts last year, provided relief for borrowers.
It definitely provided relief for the housing market. And we do think that if those rate cuts had not come, you would have likely seen the overall state of the housing market potentially in worse shape. So, we think that the Bank of Canada was absolutely right to embark on a fairly aggressive easing cycle, bring the overnight rate to 2.25, which is actually a little bit below their estimate of neutral. And they've signaled that at these levels, they do see themselves as having provided the right platform to allow the housing market and the economy to recover. So we are under no doubt that it's helped the economy.
Okay, so give me an understanding of what you expect for this year, because the Bank of Canada has signaled that it is probably where it's at and where it's going to be, at least for the near future. Do you expect a rate cut by the end of the year?
We certainly don't see any action for the first half of the year with rates where they are. And in fact, because our baseline is that the U.S. will eventually reach a deal with Canada on trade, our baseline continues to be that the BOC will be on hold through this year. We don't see further rate cuts, and that's partly because the current level of overnight rates in Canada at 2.25 is actually a lot lower than many other developed countries. And if some of these headwinds weren't there, it would actually be allowing the economy to recover quite well. And we also think some of the further kind of challenges that the housing markets face are more related to frictions in clearing risk and transfer of risk as opposed to rates themselves. So there may be other solutions required. So our baseline is that the Bank of Canada remains on hold. We're definitely more confident about that for the first half of the year. And for the second half of the year, I think there's really quite a range of scenarios because in addition to these trade uncertainties, what we've also seen over Q4 is that we've seen some healing of the labor market. You know, we saw the unemployment rate fall from 7.1% down to 6.8%. I can easily see a scenario where if the unemployment rate were to fall another half a point, there may really be no need for the Bank of Canada to consider any further cuts. So I think the year is a long period of time. We certainly don't see them moving in the first half. What they do in the second half is going to be a function of how the labor market recovers and how these trade talks go.
All right, Vinayak Seshasayee, Executive Vice President, Portfolio Manager, PIMCO. Thank you, sir.
Thank you.
Coming up, gold and silver are continuing their record runs, but is there danger ahead? More in a moment. Gold bugs are happy to start the year as the safe haven asset outperforms Bitcoin, but will that last? Let's go to Mike McGlone with Bloomberg Intelligence on this. Mike, thanks for joining us. When you look at the two over the last year, gold, of course, leads the way, but over the last 10 years, more Bitcoin. So what does this mean for 2026?
It's a significant statement, I think, because that ratio, right now it's about 18 ounces of gold per one Bitcoin. It's been dropping since last year's high. It actually got to a peak in near 40. But it has a very high correlation to the stock market. It's usually a negative indication. The key thing I'm worried about now, we have a point that gold is getting so expensive and Bitcoin's in a bear market. Typically it means that it's the indication that I'm really worried about. Typically it means that we're going to see a pickup in volatility, maybe a drop in the stock market. But I think what it tells me, the bottom line it tells me is we're probably going to see a pickup in stock market volatility this year. And that ratio is probably predicting a down year for the stock market this year.
Interesting. Okay, so you've also pointed out the correlation between Bitcoin, gold cross, and then the U.S. market cap to GDP. It's been broadening, but can you explain that out a little bit more?
So it has what I call same chart syndrome. So if you look at the U.S. stock market divided by the GDP, it's almost 2.3 times. That's about the highest in a century, since 1928 on an annual basis. But looking back at that over 10 years, the Bitcoin and gold ratio was the same chart as that. And then it broke down last year. So now we have what I call basically crocodile jaws. Stock market still going up, Bitcoin going down, Bitcoin gold ratio going down, telling you something's wrong. So I'm worried that those crocodile jaws were narrow. And yeah, we could see a bounce in Bitcoin gold, but overall, Bitcoin's in a bear market. Gold's in a bull market and expensive, and I think the key theme there is the stock market rolls over. But here's the bottom line I'm worried about is we have not had a down year for the stock market since 2009. I'm sorry, we've already had two. It looks like we're setting up for the third. By the end of the year, if the stock market's down, it's going to enhance the leading indicator for Bitcoin. I think the bottom line, though, is we've reached a peak in Bitcoin, potentially going to reach a peak in gold this year, and then what's left? I'm really worried that everything is going to have a little bit of backup as we head towards. We still have a long year ahead of us.
Let's talk about silver then. I'd love to get your thoughts. It reached a high over 100 US dollars an ounce. So what are your thoughts for silver then?
The first thing I want to mention about silver, its nickname is the devil's metal. It's got a very high volatility. It'll make you lose your hair. And you see, I used to trade some silver by the look of my hair. The key thing I want to point out is it's gone up at the highest velocity ever with stock market volatility this low and inflation this low. That's never happened. And the key thing about silver, I think it's much more speculative. We could get a 50% drawdown in silver and still near those old highs around 50. So I think to look forward in silver and gold is we're probably going to put in highs this year that'll last for many years. And silver is probably going to start on embrace and start in some 10% days, meaning up or down 10% in a volatile market. Same with gold, around 5% days as we hit more to a peak. The key thing to remember, always remember in silver, is it's an elastic commodity. When prices shift this much, it'll shift the supply higher and reduce demand and make prices peak, particularly for a long time.
All right, Mike McGlone, I'm going to leave it there. So thanks for your time. Mike is with Bloomberg Intelligence. So that speech from the Prime Minister Mark Carney in Davos earlier this week is still getting a reaction, including from the U.S. Commerce Secretary Howard Lutnick. In his own speech at the same forum, Lutnick had pointed remarks for Carney and what he described as whining from Canada. Here's CTV's Mike LeCouture on what it could mean for trade and CUSMA negotiations.
Give me a break. They have the second best deal in the world. And all I got to do is listen to this guy whine and complain?
U.S. Commerce Secretary Howard Lutnick called the Prime Minister's speech in Davos political noise. Tuesday, Mark Carney urged middle powers to band together against more powerful countries that use economic coercion. Lutnick warned those words will be remembered during this summer's trade review.
They have USMCA, which means 85% of the Canadian economy comes into the United States for zero. And there he is complaining that he's going to go to China and improve it.
Canada's finance minister pushed back on those comments.
Prime Minister said a lot of things that people thought, and he had the courage to say it loud. I think Canadians have understood by now that diversification is key.
Meanwhile, the reverberations of Carney's message continue to be felt with other world leaders.
I think we have a lot of Europeans who are in this first camp of multilateralism, whereas the American administration is driving multipolarity. And we're trying to make these two things meet.
Australia's treasurer called the speech stunning, adding it makes a powerful point about the old world order being over.
So the job for us, the job for our Canadian friends, is to work out how we can shape all of this change in our own interests.
California governor and possible Democratic presidential contender Gavin Newsom also praised Carney at Davos for calling out the current state of the world, adding Americans need to do the same. Mike LeCouture, CTV News, Ottawa.
All right, let's have a last look at the markets before the end of the trading day and the end of the trading week. The TSX Composite gaining today 147 points, so it's at 33,150, up almost 0.5%. The S&P not a material move on the day. The Nasdaq a 62-point move up, about 0.25%. But we'll bring you the closing numbers when we come back. Stay tuned. Here are the closing bells for the end of the trading day and the end of the trading week at the Nasdaq. Partnership for Maternal and Child Health of Northern New Jersey honoring Maternal Health Awareness Day. In New York, Zeta Global to celebrate the full beta launch of Athena, the AI super intelligent agent. You're watching the close on BNN Bloomberg. I'm Morello Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX gaining 142 points by the end of the day, and that is a new record close of 33,144. The TSX up about 31% over the last year. Let's go south of the border. Some of the key markets are trending red and still are red today. S&P not a material move, but the Dow Jones a 285-point drop. That's about 0.6%. And the Nasdaq has a 65-point move up, about 0.3%. Let's get to the movers in Toronto. Capstone Copper had an 8.7% move up, $1.24 per share. It had lost earlier in the week because of a labor disruption, so this is a reversal today. Aya Gold and Silver also on the move today. It's gained 6.4%. That could be with the big move of silver today, breaking and making a new record. Let's get to Discovery Silver. It also gained today over 6%, a 70-cent move up, so taking the share price to $11.64. Bausch Health, on the flip side, today down 11%, a loss of $1 per share, taking it to $8.07. They had some disappointing trial results. Stephanie will have more on that in just a moment. And Nova Gold is also down today, 6.1%, or 89 cents a share, dropped at $13.57. And Bloomberg's equities reporter Stephanie Hughes joins us now with more news. All right, Stephanie, Bausch Health does bounce around a lot, but a steeper drop today. What happened?
Yeah, that's right. So just as you pointed out, Marella, happy Friday, by the way. Bausch Health having less of a happy Friday. Those shares fell by over 11% at their lowest point, which dragged the stock price to its lowest level since August. And in fact, it was the sharpest decline since last summer in late July. And it was because Bausch Health, a pharmaceutical healthcare company, said that the phase 3 clinical trials for a medication that is designed to treat chronic liver disease didn't quite meet the primary endpoint. So that's, in translation, that basically was a failed trial. And a Barclays analyst kind of added to it, saying the trial update sort of raises some questions about how the company will plan to meet some longer-term debt obligations. So as you pointed out, it is a volatile stock over the past year. And this is another setback that's just kind of layering on top of that. It spent most of the past year deep in the red. And looking at that one-year chart, it is down by well over 20% at this point. Setbacks like this are probably not helping. And you can see traders respond in kind, Marella.
Okay, let's get to Aya Gold and silver. We had silver boosting quite a bit today. Is that what pushed Aya Gold up?
Matter of fact, that's exactly what's pushing Aya Gold and Silver up to the tune of about 8%, which brought the stock to another all-time high. It was also one of the top performers on the TSX. In fact, it was the top performer until Capstone Copper overtook it. But this is further building on the precious metals rally as that put silver prices on top of $100 an ounce for the first time ever. It's a matter of global retail markets continuing to flock to these safe haven assets as uncertainty is causing them to flock to these assets that in reaction to these jarring headlines. So there's no shortage of that these past few weeks for sure. You've got your shaky relations between the U.S. and Europe over President Donald Trump's ambitions on Greenland. You've got the DOJ's attack on the Federal Reserve's independence, and then a few other major global conflicts that are still underway. And obviously this has been a really dominant theme last year that's still carrying over to this year. And it's putting names like Aya Gold and Silver among the top performers, and Discovery Silver as well, as you mentioned before I started talking. It's another shine on silver kind of a day, Marella.
Yeah, remember Venezuela, which already seems like it was so long ago? That was only a couple of weeks ago. Okay. Bloomberg, Stephanie Hughes, thanks for the update. Have a good weekend. All right, let's go to check some movers south of the border. We have Bloomberg's Carmen Reinecke joining us now. Thanks for joining us. Let's get to Intel. They had earnings reported last night, and they're having inventory issues, so that resulted in the stock moving down. But share some more.
Yeah, so the stock is down 17% today. This is the worst close since August 2024, which was also a huge day where the stock fell off of, a less than desirable earnings report. We've erased more than $45 billion in market cap. And really what we saw from Intel is that not only were expectations, I think, from Wall Street pretty light for this company, but they failed to even meet those Wall Street estimates in their forecast for the first quarter. And the CEO basically said that they're having, these production issues. They're sort of struggling to get more, or to see if they can get more clients for its foundry, which is also something that investors have really been looking for and sort of were bidding up the stock earlier in the year. So not a good day for Intel. This also comes off of pretty strong performance for the shares, though. I'd like to point out the stock moved up more than 80% last year and had continued to rally, this year up until yesterday's close. I think it was up 45% year to date. So not a good result for Intel today, but the stock has been seeing some strong rebound.
Okay, let's get to Capital One, also moving down today after a miss on earnings. Tell us more about how they missed or what happened there.
Yeah, so Capital One shares are down 7.5%. It's their worst one-day drop since April. So the bank's adjusted earnings per share missed the average analyst estimate, and that was driven by higher than expected costs. So the other thing that's really going on here is that it agreed to buy Brex, and this is an acquisition that will initially be EPS dilutive, according to TD Cowen, and quite a few other Wall Street analysts also mentioned sort of this deal and its impact on earnings, or expected impact on earnings going forward. So this has extended a decline over the last few weeks, and it reversed a gain of about 35% last year.
Okay, let's get to Sable Offshore. Oil and gas company shares down over 10% today. What happened there?
Yeah, so I'm seeing a 16% drop, the worst since November 14th. So California has sued the Trump administration for giving Sable Offshore the permission to restart a controversial oil pipeline in the state. So basically what happened is they got like emergency permission from the Trump administration to restart this pipeline. And now California is saying that the federal government's actions were an unlawful power grab and that there wasn't really a state of emergency. And so they should not have been given, the permission to go ahead and reopen that pipeline.
Got it. Okay. Thank you very much for joining us, Bloomberg Carmen Reinicki, with the latest going on there. Coming up next, American markets ended a volatile week with some choppy trading, as you saw. We'll dig deeper when we come back. My next guest says the key lesson for investors this week is to stay focused on fundamentals rather than rhetoric from a small Swiss village. Let's go to Christopher Davis, partner at Hudson Value Partners. Christopher, thanks for joining us today. It's hard to ignore threats of war. However, if we're tuning into earnings so far, what have you noticed?
Well, with the companies that we've been following in earnings season so far, Morella, the reports have been good. And if we look at some of the macroeconomic indicators, whether it's things like GDP now or some of the different fundamentals or even some of the cooler inflation prints we're seeing, or inflation certainly not getting worse, these are all positive things for the economy. And when we look at something like we're seeing where you could have GDP growth in the 4 or 5% region in the U.S., it's hard to get too bearish. And while there was a lot of noise and a lot of rhetoric coming from the politicians in Davos, and certainly I'm no stranger to rhetoric as someone who lives and works in Palm Beach, Florida, we certainly get it from a village here and a village over there. The reality is staying with that fundamental company by company data, it ended up being just a fine week.
Yeah, I'm sure the noise is very loud where you are. So gold has been gaining on the uncertainty. Do you think it'll still move the same way this year?
Yeah, I think as long as geopolitical risk and geopolitical instability is out there, that's a bull market for gold. And the important thing that we see is that central bank demand for gold, particularly as banks look to diversify their reserves, we think that's raised the floor in a lot of regards for the gold price. Doesn't mean we won't see a correction over time, but we think, that floor in gold prices edges higher. And when we look at gold prices, we like to look at them across a basket of major currencies, not just the US dollar or the Canadian dollar, but across, euros, pounds, rupees, renminbi. And what we notice is that across the world right now, gold is up between 14 and 16%. The outliers are the Indian rupee, which is, done fared a little worse against gold, and the Aussie dollar, which has been stronger. And that makes sense given the importance of mining in that economy. But when you see that way, with most currencies, trading against gold in a similar range, suggests to us that it's demand. It's not one central bank losing credibility or one particular currency blowing out. So we think it's just a demand side story right now.
Okay, so you took a global look. Are there certain gold stocks you do like right now?
Yeah, we're still holders of Franco-Nevada. We love the royalty space. We think when we look at what Q1 earnings are going to look like and what we're going to get the report on Q4, given where gold prices are and the discipline the management team has shown there, we think it's going to be a pretty rosy report. Of course, some of that is already baked into the price from here. But as these companies report and as gold prices stay higher, the company's going to get cheaper on an earnings basis because their all-in sustaining costs are not growing dramatically. In our ETF portfolios, we also own GDX, the basket of gold miners, which has really been a rocket ship over the past year. And those companies are really still exhibiting a good amount of discipline on capital allocation front between exploration, not doing any sort of crazy M&A, which are all good things you want to see as an equity holder.
Okay, so GDX is VanEck gold mine. Okay, let's have a look at silver as well, because of course it pushed above $100 US an ounce today, so a record there. But you have concerns. What are they?
Yeah, I think anytime you see a commodity, and particularly any chart that goes up like that, you have to remember that commodities in particular can have a certain symmetry to their chart patterns. They don't always go to the sky like that, and when they correct, they tend to correct not over time, but in sharp moves. So I think, as an investor, certainly if you've been in silver mining stocks, you've done extraordinarily well, but you just have to respect the ferocity of that move and understand that, a pullback could be in the 20, 30 to 40% range. And that bull market in gold and in silver could, still very well be intact, even with, a pullback of that magnitude. So it's just something you have to keep in mind and be a little wary of. You don't have that same level of central bank demand with silver as you do gold. It's a little bit more of a trading commodity and a little bit more of, some industrial demand as well.
Let's get to a couple of your picks. They're value picks. The first one is OKE. Tell me about it.
Yeah, ONEOK. So, Marilla, always a little bit of trepidation on my part as an American to go on Canadian television and pitch an energy stock. But we think ONEOK is a good reason to look south of the border. And that chart right there tells a good part of the story. We got involved right around November of last year in the fourth quarter. And ONEOK investors had suffered over the course of the year. It's a natural gas pipeline throughout the U.S. They had made about 3 different acquisitions over the past 3 years. And the integration story has just taken time. And the reality is, in every sort of M&A merger integration that you see out there, it always takes longer. And in ONEOK, we see a company that's, about a $49 billion market cap, 629 million shares outstanding, trading at 14 times forward earnings. Right now, you get paid a 5.4% dividend yield. And I think, it's a good total return story going forward. We see a lot of confidence in the management team, who in the past year has increased the dividend, bought back stock, and paid down debt. That's a capital allocation trifecta, and that's shows some real confidence. And we think 2026 should be the year that both the financial engineering element here and the merger integration synergies come into play, and it should be a good winner in people's portfolios.
Okay.
And I also think just would add that it is a C Corp, so whether you're on the north side of the border or the south side of the border, it's a lot easier to hold than some of the publicly traded partnerships out there.
Okay, we do have to leave it there. I'm out of time with you, sir, but thanks for joining us. Christopher Davis, partner at Hudson Value Partners. Coming up next, a regional bank crisis in 2023 was pretty scary for some. So is the sector continuing to recover in 2026? We'll find out. More in a moment. In March of 2023, the failure of 3 mid-sized U.S. regional banks sent the sector into a sharp downturn and forced action to stop a broader collapse. Regional banks have started to report some earnings this year. Let's talk about that and what we've seen so far with Alexander Yoakum, Senior Vice President of Equity Research at CFRA. Thanks for joining us today.
Yeah, thanks for having me on.
How long do you think the 2023 scare left an impression, maybe deterred investors from putting money into regional banks?
Yeah, honestly, for several years. We had that regional bank crisis. And then after that, all eyes turned to commercial real estate. So there were some concerns there. We saw the not total collapse, but a significant drawdown in Flagstar. And then, investors started looking for issues across other regional banks, and they did find some. So 2022, 2023, 2024, a lot of these banks saw earnings contraction. It was really not until 2025 where we saw some improvement in sentiment, started to see a little bit of valuation improvement, but still, these banks are still well off where they could be in our view.
Okay, so what kind of year did they have last year when compared to the S&P?
Yeah, so they were a bit down comparatively. They were still up about 7% on the year on average, but there was some issues. So we had, of course, the tariffs really went into stage in April, and that ended up leading to loan growth underperformance. So we were hoping 2025 would be a strong year for loan growth, but the tariffs really stalled that out. Small businesses didn't really want to make decisions because they didn't know how tariffs were going to impact their businesses. So loan growth was quite weak. And then in the fall, we had some issues with credit quality. You may recall the bankruptcies of First Brands Tricolor. That sort of caused some issues with regional banks. Investors were concerned that that could spread, so they sold off regional banks. But at the time, we mentioned that we thought those were somewhat isolated. And positively, we haven't seen those credit concerns come up in the fourth quarter. That was more a third quarter incident, and we haven't seen it spread. So that's a real positive.
Okay, so on earnings so far this year, what are you seeing?
Yeah, so like I said, the real takeaway is credit quality, because that has been a concern for regional banks for a while now, and that has been improving. Commercial real estate losses have been coming down, and forward indicators are quite positive. When we look at guidance, generally speaking, management was guiding towards improved credit quality. Loan growth also, like I mentioned, was pretty weak last year, but it started to accelerate towards the end of the year, and it's looking like that's going to continue, especially in areas like businesses. Businesses are a little bit more optimistic. Obviously, there's been some geopolitical issues as of late, but if you actually look at areas like recession odds, they've been actually falling. So they started the year a little under 30% odds for the U.S. Now we're in the low 20s odds of a recession, so that's been improving as well. So net interest income is looking good with the loan growth. We also have sort of an interesting story where the regional banks have an advantage over the large banks in the sense that they underperformed previously, so the bar is easier for them to rise. So for example, if you look at deposit costs, after Silicon Valley Bank, regional banks had to pay up for deposits. So that was a strain on their performance. But with interest rates coming down, that benefits them more than the large banks, which didn't have that pressure. So they're positioned well to see margin expansion along with that loan growth should be nice for net interest income, which is, of course, their main source of revenue.
Okay, so let's talk about which of the regional banks you're liking right now and why.
Yeah, so our top pick, and it has been for a while now, is East West Bancorp. So this is a smaller regional bank in California, but we really think they often, get criticized unfairly. So if we think about 2023 with Silicon Valley Bank, they really did sell off significantly because they are a California-based bank. But at the time, they actually put out a press release and their deposits did not fall. So while regional banks were seeing deposit outflows, that didn't occur for them. And that is because of their strong customer base. They do target Asian Americans. And because of that, they have a little bit of a niche and their customers are less likely to leave. Then, as you can see on this chart right here, during April, we had that tariff sell-off, and that was pretty significant. Because they do target Asian Americans, there was some concern that they might see some losses, especially because they deal a lot with Chinese customers. But we would point out that their actual exposure to loans outside of the U.S. is very little. And then if you actually look at their charge-offs, they didn't fall or they didn't get worse. They actually improved. So they got better and better. And then also there was a little bit of a fear around in the fall around these losses, these NDFI losses, and they didn't have issues there. So they've done quite well in terms of that. So each time there's a concern, they've actually outperformed the industry. And then if you look at terms of growth, their deposits, their loans, their revenue, and their earnings all outgrow the industry pretty much every year. And despite all of that, I would say their valuation is actually still somewhat depressed just because there is always concern with the Asian American ties. But like I mentioned, their actual performance is almost all U.S. based. So we think that's usually overblown.
Okay, so that's East West Bank. Is there a second you do like at this point?
Yeah, so one I would like to point out would be Citizens Financial Group. So this is a bank which historically we were a little bit more neutral on, but more recently we've become more bullish. And why is that? You can see they've actually outperformed over the last year. So I mentioned regional banks generally underperformed. This is actually a bank that has outperformed. And the reason for that is they have now a competitive niche. Regional banking is very competitive, so we don't tend to like banks that are just kind of like all the other ones. We like the banks that have a competitive niche. And what they did is they actually picked up some wealth managers from the failed First Republic. And at the time, it was a bit of a tough look because you're sort of copying a failed bank. But we would point out that First Republic didn't fail because of its wealth. It failed because they had a large amount of uninsured deposits, which Citizens does not have that issue. And then they also failed because they had asset liability mismatch, which Citizens does not have that issue. So those two issues they don't have, but they do get the benefits. So they're building out this private bank, and this private bank is been pretty successful so far. So we've seen significant loan growth, significant deposit growth. AUM is increasing, and when you have that wealth, you can really get an expanded multiple, and we think that's likely to continue. And then we would also just mentioned that in terms of areas like loan growth, it's an area that they had previously struggled at, but it started to accelerate partly because of that private bank, but then also partly just because the economic environment has improved.
Alexander Yoakum, got to leave it there. Thank you for joining us today. Appreciate it.
Yeah, thank you for having me on.
Coming up, the president of the European Central Bank says she doesn't agree with Mark Carney that the world order is rupturing. More in a moment. Here are the stories we're following in the newsroom today. Canadian retail sales rose 1.3% in November over the month before. That's coming from Statistics Canada. They say the increase was led by gains at food and beverage retailers. Core sales climbed 1.6%, though an advance estimate suggests overall retail activity dipped in December. The U.S. President Donald Trump says Prime Minister Mark Carney is no longer invited to join his Board of Peace, which is a U.S.-led effort to oversee the reconstruction of Gaza. Trump made that announcement online. Carney delivered a speech at the World Economic Forum warning against coercive tactics by the world's great powers. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. But Ottawa faces criticism over that deal signed by our prime minister and the Chinese president. The Ontario Premier is Doug Ford, and he recently urged Canadians to boycott Chinese EVs. He says the vehicles put thousands of auto sector jobs at risk. Bausch Health was one of the biggest decliners on the TSX today after the failure of 2 clinical trials. Both were testing a better form of a drug called rifaximin to see whether it could help prevent brain damage in adults with liver disease. The company's CEO says they're reviewing data to identify new development opportunities. Prime Minister Carney's Davos warning about a ruptured world order made global headlines, but some leaders are pushing back. European Central Bank President Christine Lagarde says she's not exactly on the same page. To break all of this down, we were joined by Paul Sampson, president of the Center for International Governance.
You know, America First has some sense, others should do more, but then there were aggressive tariffs, there was the takeover of Venezuela, and then above all, Greenland annexation in any means possible, right? And that was, I think that was the tipping point that actually created a rupture, which I think is true as opposed to a transition.
Sorry, give us that point again. Where is the key point of contention here?
Well, I think the America First has gone too far in its aggressiveness, right? I mean, the idea of annexing a state within the NATO alliance, within your closest partnership, by any means necessary, is actually a rupture, right? That's not a transition. A transition is new technologies and things like that, and emerging economies, and that's been going on for the last decade or so. But the rupture arrived.
But to say that we're just into a new era for the world, some people find that's going a bit far.
Yeah, I mean, I think that you get the reaction of Christine Lagarde and others. They're incrementalists by the definition of their job. That the status quo, they need some status quo to keep chipping away at their mandates, right? Like the rupture is a problem for them. If there are new regimes that emerge, like plurilateral ones, like a trading regime in Asia Pacific that doesn't include the U.S. and China, that's a very different kind of regime, right? You know, she's heading up the ECB, but she's still wearing her IMF hat a little bit, I think, on this. And I think she just wants to go slow and she wants a transition. But I think it's more than that. Many leaders have come out and said they agree with Carney's speech. Mexico, Finland, Australia, they're kind of saying, yeah, this is what's happened.
I'm looking at a headline here in The Guardian of England, which, of course, would be no fan of President Trump. Mark Carney is emerging as the unflinching realist ready to tackle Trump. So he really put himself on the world stage there.
He did. I mean, he is a realist. I think that between Canada and the U.S., it's a spat, right? It's a phase. It's a tough one. But in the end, they're going to get along, right? This huge border with the integration, like that's not going to go away. But there's a spat going on big time. And now it's global, right? Because this is it's affecting every country. There's no country that's not pulled into this right now.
I mean, for a long time, America avoided actually having colonial possessions. It preferred to, well, dominate countries, let's put it that way, if you want to put it that way, or to exercise its power through trade and technology transfers, etc. But this grasping for territory, or apparent grasping for territory by the president, it looks like a new thing.
Yeah, I think that was the tipping point, right? It didn't really make sense because the U.S. has a base on Greenland, a major military base. So they kind of have access now. You've got to think this was about controlling critical minerals in the future and shipping lanes through the Northwest Passage and that kind of thing, why they wanted more, because they kind of have it now. And it does cross the line, right? And I think that's why you're seeing the reaction. There's also just an opportunity for middle powers to assert some collective power here, right? Like, you know, they don't want to get pushed around by the biggest players.
I suppose some people might say, well, Christine Lagarde, she's the voice of the establishment. The current system has suited her very well. Do we need people with a bolder vision, perhaps, such as Mr. Carney, to weigh in here?
I would say yes, because it's that much change has gone on. I mean, I think Christine Lagarde is very competent in many ways of her job, but she does represent the old guard. It sounds a little ironic, but you know, she's definitely an incrementalist and sees it as, you know, we're on the right plane. Let's just make some adjustments. I think the world has changed more than that, and most countries see it that way.
Lagarde says, sure, trade has suffered the biggest disruption in 80 years, but I think the system has been put together in such a way that it's quite strong and it will take a lot to destroy. Well, she may have a point there.
Yeah, it's a great system. It's delivered a lot of things. It hasn't delivered on equality enough, right? Within countries, the gap has been growing. Between countries, it's still too big. So the system hasn't fully delivered, which is part of the backlash in the U.S. Too much globalization. They're totally right in the U.S. They needed to dial that back a little bit. Other countries needed to do more. It's not an outrageous. Parts of America First are legitimate, but not the excessive parts, right? Including aggressive tariffs and certainly land grabs.
Yeah, we're putting up a board from El País of Spain. Carney leads the moral and geopolitical opposition to Trumpism in Davos. And that's the quality Spanish paper. So. Right. I mean, the speech really struck me as being pretty extraordinary for a Canadian leader to make.
Yeah, some people have called it the biggest speech ever at Davos. You know, there was a standing ovation on site. Like there were people found things they liked in there. There are some things to not like, for sure, from the U.S. side. I'm not sure they're going to take it at every word. Ultimately, what's going to matter here is action, and Canada and other countries are going to have to really step up, facilitate new conversations, new ideas. This doesn't just happen on its own.
Paul Sampson is president of the Center for International Governance. Straight ahead, the big tech stories that are happening right now, from social media bans to chip makers. Back in a moment. TikTok lives another day, but Canada will do another national security review. Let's start there with Carmi Levy, technology analyst. You joined us now. Carmi, do you anticipate there will have to be some Canadian ownership in TikTok the same way the U.S. has gone?
I don't see that necessarily happening north of the border. I think Canada has already played its card in terms of trying to force TikTok Canada to close their offices here. That order, of course, was made in late 2024, back when the U.S. was still adversarial toward TikTok's global operations and was still kind of leaning toward, under that Biden administration law, toward getting them to shut down in the U.S. unless they sold their American operations to an American owner. Whereas now the U.S. government is clearly in support of TikTok. And so Canada did not want to seem out of step with it. Federal court ruled that that shutdown order for those offices would be set aside and sent back to Industry Canada. Now it's with Industry Minister Melanie Joly. She can, essentially decide what to do next. But I just don't see that, given sort of where TikTok is in the context of how geopolitics have evolved since all of these laws and orders were first enacted, I just don't see a significant amount of hunger in Canada for any kind of shutdown. I think status quo, maintain kind of business as usual, and allow TikTok Canada to reestablish relationships with members of the community that it had been supporting all along, and ensure that that sub economy, that ecosystem of digital creators, of influencers, of small Canadian businesses that rely on the platform continue to get the support locally.
Okay, let's move to Australia's ban for children on social media, and Canada's considering something quite similar. Tell us about that.
Yeah, we are seeing reports that as part of the expected this year reintroduction of the Online Harms Act, which of course disappeared when the last federal election was called, the law died on the docket, that an age gate would be included in it. Right now, of course, in Canada, the law is 13 is the cutoff age for social media. But of course, what's changed since that first became standard is now Australia has a new piece of legislation, been enacted for about a month. And they're already starting to succeed in getting millions of accounts removed from those platforms. And now countries around the world, including Denmark, France, the UK, Malaysia, Indonesia, are lining up with legislation or plans of their own to follow Australia's lead. So Canada's announcement is much more modest. It would move the age from 13 to 14 and possibly include some kind of regulatory oversight. Not as heavy as it was in the last online harms bill, but remains to be seen. But as is often the case, Canada's kind of a step behind the rest of the world. We're not as aggressive in holding tech companies to account, which of course shareholders love, because the tougher you are on age gating, on restricting demographic groups from the platform, obviously the more difficult that is to grow engagement, grow your network size, and grow revenues. So it's a bit of a balance here, and Canada has decided to kind of ease back on the gas pedal while other countries are going for broke.
Okay, we heard social media companies say back when it was too hard to try and police the space, right? Too hard to try and figure out who was rightfully on and who shouldn't be on. So how would this actually work?
There are better technologies available now. We're seeing many of them in action in Australia. Artificial intelligence is much better now than it was even a couple of years ago at scanning an individual's account configuration, their activities on the platform, who they interact with, how they interact with them, and then determining from all of that, all the signals, how old they think they are. And it's fairly accurate. There's a fairly low percentage of false positives, for example, that we're seeing in Australia. So yeah, they've been complaining all along because they certainly don't want to be spending the engineering resources on something that would ultimately compromise their business. But as time goes on, they are they're increasingly integrating AI platforms into their social media tools, so they can use that for much more precise age gating than was available even recently.
Okay, let's get to OpenAI wants to now cash in on ChatGPT. What are your concerns about this?
Well, I mean, concerns are, if we were concerned about Google doing this 25 years ago, we should be even more concerned, because that's the way the industry works. We should be even more concerned when an AI company says they'll be doing the same thing. It collects a lot more information from much more, a much broader swath of end user activity. And that means that the potential for privacy violations, for crossing that line with advertisers, for taking personal conversations and having them available to third parties is much more, the risk is much higher. And of course, OpenAI is a company that has very aggressively fought in court to protect its interests. And so certainly, they say that, they won't mix the two, but certainly based on history, not necessarily a company we can trust.
Yeah. Got to leave it there, Carmi. Good for you to join us. So thanks for your time. Have a good weekend.
Appreciate it, Marilla. You too.
Up next, if the AI bubble does burst, what consequences could there be? We'll find out when we come back. The AI boom is everywhere, but much of the money flows between a few players who have yet to profit. If it is a bubble that pops, the consequences could be dire for everyone. This week's Bloomberg Doc dives in.
From Wall Street to rural America, today's AI is the economy, and markets have priced it like a miracle that can't fail.
Investors are really banking on incredible growth. Microsoft, Meta, Alphabet, they are just committing billions and billions of dollars to capital expenditures and expected to continue to, raise those numbers over time.
The AI boom is more than just software, it's construction. So that's building out the data centers, that's securing the energy that's needed, the water that's needed.
But in this burgeoning industry, what goes around doesn't necessarily come around.
A precarious investment strategy is emerging.
Multi-billion-dollar circular deals.
NVIDIA will invest as much as $100 billion in OpenAI.
The merry-go-round of money continues.
Huge sums of money are just being passed between these enormous companies that are pouring hundreds of billions of dollars into the promise of AI.
And the promise is huge.
About 80% of U.S. businesses use AI. So this is a structural shift, like electricity or the internet.
But AI, with all its potential, remains largely unproven for profitability.
Probably the biggest question in San Francisco right now is, are we in an AI bubble? And if we are, then, well, how big is this bubble and how bad would it be if and when it does burst?
So, is this the dawn of a new age of AI-powered growth? Or the biggest bubble ever?
A circular deal is when companies are basically blowing money, products, services in between two of them.
NVIDIA has said it's going to invest up to $100 billion in OpenAI. At the same time, OpenAI is a major customer of NVIDIA's services, of their chips. To make it even more complicated, there are also sort of other middlemen. One example is Oracle. OpenAI sometimes will lease compute from Oracle. And so you have Oracle being a customer of NVIDIA. So you can see how there can be more sort of arrows back and forth between these companies.
But NVIDIA, OpenAI, and Oracle are just part of the web. The full picture entails a who's who of the AI landscape.
This money is kind of spinning around the same companies, and that's why people are worried.
I don't think there's anything inappropriate about that in principle. Now, if you start stacking these where they get to huge amounts of money, then yeah, you can overextend yourself, of course.
It becomes kind of symbiotic, and I think that's sort of the concern that's cropping up now, is that if one of those companies stumbles or doesn't do well, does the whole thing fall apart?
A lot of this investment is going straight to the build-out of data centers across the nation.
We're really in an infrastructure build-out arms race.
Have a look at construction spending in 2025. It's down in most sectors, but not data centers or power stations.
We're seeing a lot of companies that are sort of the picks and shovels of the AI industry. They're out there actually, digging into the ground. One recent estimate from Morgan Stanley predicts that companies will spend $3 trillion on AI data centers. That is obviously a major bet.
If you're in the business of selling picks and shovels, you are living it up. You are getting all the money you need, and there's more demand than you can meet.
We're currently in a facility that was once upon a time a textile facility, one of the largest ones on the eastern seaboard, about 1 million square foot. We realized we could actually repurpose it as a data center.
There is an insatiable demand for building data centers, for making sure that we have the power to build the data centers, the megawatts, the infrastructure, and the expertise. We don't see any slowdown in that for a long while. When it comes to artificial intelligence, time is not your friend. So if you can get up and running in 6 months using a retrofit format versus a greenfield format, which is starting from scratch, which takes up to 2 years, that's a much better proposition.
All these data centers need power. The growth in utility costs is outpacing inflation.
Utility companies have done really well, especially ones that are providing energy to data centers. Construction stocks have done well.
But building fast isn't always built to last.
You don't just build a data center, switch it on, forget about it, and make money. You have to keep on investing to keep that technology working. Otherwise, it will quickly become useless to the people you want to sell it to.
And so far, all major AI projects are operating at a loss.
The problem is, every time someone uses ChatGPT, OpenAI likely loses money.
Those OpenAIs and Anthropics of the world are not yet profitable.
Sam Altman says OpenAI should be able to break even around 2029, 2030. Given the amount of cash that company is burning through right now and the amount it still needs to spend to build the data centers and pay for the computing power to do what it wants to do, that feels like a tall order to me.
There's some concern about whether the AI startups are actually able to pay their bills when they're racking up these huge commitments to spending on data center infrastructure.
These AI data center companies, they are the kind of canary in the coal mine. They are the ones where we perhaps see on their balance sheet any first sign of companies pulling back from needing as much AI data center capacity.
Right now, all the companies, they're all saying that the demand for AI products is really, really high. If that were to change, if demand were to suddenly weaken, that would become an issue.
To understand the stakes of today's AI boom, you don't need a crystal ball, just a quick trip down memory lane.
You've got mail.
In 2000, the dot-coms promised a brave new world. Instead, we got wiped out savings, empty office parks, and $5 trillion in vanished value.
The worst hit shares around the world have been the technology stocks, including the dot-com companies.
Even the strongest companies in that era took years to recover. Amazon, one of the big, great, famous survivors, its share price didn't recover for another 8 years after the dot-com crash happened. Cisco, one of the picks and shovel companies, it took them 25 years before their stock price recovered.
There are definitely some similarities. One is that there is circular deal making in both instances. The question is this bubble going to get to a level that goes beyond just kind of the normal ups and downs of tech booms, but actually has major consequences for the economy?
The dot-com boom was devastating for the economy, but I don't think it would compare to the far-reaching effects of the AI boom collapsing.
The money pouring in has been a huge contributor of growth to GDP, helping boost a U.S. economy otherwise hampered by tariffs and inflation. Everyday Americans are exposed to this risk via 401ks and other investment accounts that hold stakes in many of the big tech companies participating in the spending spree. So does that mean the AI bubble is too big to pop?
There's definitely this question about, are these companies becoming too big to fail? If they were to go down, that could have not just economic consequences.
There is a suggestion this might be like the global financial crisis, where huge financial institutions needed money to survive to prevent a wider collapse of the economy. Then that's obviously a far greater problem for the US economy.
But despite these stakes, many remain bullish on AI because of the evolving nature of the technology itself.
In the dot-com boom, there were companies that were laying fiber optic cable. Like subsidiaries of a company were basically all spending in a circle, and it did contribute to the dot-com bubble popping.
But after a while, that became the backbone of internet broadband. And that unused part of all the fiber optics that were built in the 90s actually ended up being extremely important for the internet. And so we think with respect to data centers, if there is potential excess capacity that's being built, those data centers will eventually be used.
There's a scenario here where AI takes longer than we think, and therefore the strongest companies, sure, they'll survive. But in the meantime, there might be a huge hit to their valuations.
Ultimately, this technology is not going to burst. There are certain companies that will not make it, but AI itself is not a bubble. There are real products.
It's clearly the biggest gamble that Wall Street has ever made. And this is a street known for its gambling. This is the wager to end them all.
Thanks for joining us today on The Close. Have a good weekend. We'll see you Monday.